On July 2nd, 1997, the Bank of Thailand let go of the baht. Within 6 months, 5 Asian currencies had broken their dollar pegs in sequence. By the end of 1998, Russia had defaulted on its domestic debt. Long-term capital management, a hedge fund with $30 of borrowing for every dollar of capital, had been kept alive only by a Federal Reserve organized rescue. In dollar terms, regional equity markets lost roughly 60%. Asian central banks lost the better part of $1 trillion in capital outflows, reserve burns, and balance sheet repair. One currency peg broke in Bangkok. 6 months later, the chain ended in Moscow and on a conference room table at the New York Fed. By the mid-1990s, most major Southeast and East Asian currencies were either formally pegged or de facto pegged to the US dollar, the Thai baht around 25 per dollar, the Indonesian rupiah around 2,400, the Malaysian ringgit around 2.5, the Korean won inside a narrow daily band, the Hong Kong dollar formally fixed at 780 under a currency board. The pegs, combined with high domestic interest rates, produced a multi-year capital inflow boom. Foreign money flowed into Asian banks and corporates, mostly as short-term dollar-denominated debt, the cheapest way to finance a high-yielding local currency asset. By mid-1997, Thailand had about $45 billion in short-term external debt, against $30 billion in foreign exchange reserves. Korea had $70 billion against 30. Indonesia had $35 billion against a smaller reserve. The architecture was identical across the region. Dollar liabilities, local currency assets, peg holding the gap stable. When a peg broke, the dollar liabilities exploded in local currency terms. Overnight. That was the trap. Quick pause. This episode is sponsored by a private community I run. It's where the YouTube version of these case studies becomes a working framework for spotting unsustainable pegs, reading capital flight signals, and tracing contagion networks before they reach the headlines. If the architecture in the next 6 minutes, 5 currencies, 1 peg break, 6 months, caught you, that's exactly what the insight is for. Link is in the description below. Now, back to Bangkok. After months of speculative pressure that had depleted Thailand's official foreign exchange reserves, the Bank of Thailand announced on July 2nd, 1997, that it would let the baht float and withdraw support for distressed non-bank financial institutions. The baht depreciated immediately. By year-end 1997, the rate had moved from 25 baht per dollar to roughly 56, a 55% currency loss in 6 months. The float exposed 3 facts simultaneously. Thai banks were holding dollar-denominated short-term debt against baht-denominated assets, an instant balance sheet hole. The real estate sector, which had been financed by those dollar loans, was overbuilt, and the IMF would need to be called in. Thailand requested a $17.2 billion program on August 20th. The baht was the first domino. The chain had already been built. Within 6 weeks, 3 more currencies would float. The chain ran fast. On July 11th, the Philippine peso's band was widened. On August 14th, the same day, both the Malaysian ringgit and the Indonesian rupiah lost their managed regimes. The ringgit's band widened, the rupiah cut to free float. The Indonesian rupiah's path was the most severe. The rupiah went from about 2,500 per dollar before the float to 10,000 per dollar by January 1998 to nearly 15,000 by June, 83% below baseline. The political collapse followed the currency. President Suharto, who had ruled Indonesia for 32 years, resigned on May 21, 1998. His vice president, B.J. Habibie assumed the presidency. Korea's acute phase compressed into 50 days. November 5th, Korea entered an IMF standby arrangement, $10 billion. November 17th, the ones band widened. The currency lost half its value by year-end. December 4th, the IMF announced a $21 billion package. December 24th, the New York Fed hosted a meeting with U.S. banks holding the largest exposures to Korean banks. The U.S. banks agreed to roll over their short-term loans. Across the Asia Five, Indonesia, Korea, Malaysia, Philippines, Thailand, net capital outflows reached about $80 billion over 6 quarters. The international community mobilized $118 billion in rescue commitments to Thailand, Indonesia, and South Korea. Asian regional equity markets lost roughly 60% in dollar terms. The political register followed. At the IMF and World Bank Conference in Hong Kong in September 1997, Malaysian Prime Minister Mahathir Mohamad called currency trading immoral and blamed rogue speculators, pointing specifically at George Soros. Soros's response on the conference floor was 8 words long. Dr. Mahathir is a menace to his own country. The Asian crisis weakened global commodity demand. Oil prices fell. Russia's fiscal position, already strained by the post-Soviet transition, deteriorated. Short-term Russian treasury bills, the GKOs, traded at yields above 100% by mid-July 1998. On August 17, 1998, the Russian government announced default on ruble-denominated treasury bills maturing before end 1999 and widened the exchange rate band. In early September, the ruble was floated from about 6 rubles per dollar pre-crisis. The rate stabilized at roughly 25 by spring 1999, with brief late December weakness near 28. Long-term Capital Management, a hedge fund founded by John Merriweather in 1994, had built convergence trades across Asian and emerging market spreads. The Russia default broke the convergence. By end 1997, LTCM was holding about $30 of debt for every dollar of capital. By September 1998, the fund was approaching forced liquidation. On September 23, 1998, the Federal Reserve Bank of New York convened a consortium of 14 banks and brokerage firms. They agreed to invest $3.6 billion in LTCM to prevent its collapse. The Fed organized but did not put its own funds at risk. The capital infusion forestalled a fire sale into already turbulent markets. The Federal Reserve cut the federal funds rate 3 times in fall 1998, September 29th, October 15th, November 17th, 75 basis points in 7 weeks. The global liquidity squeeze that had started with the Thai baht float 15 months earlier finally reached the U.S. monetary policy response. There is a pattern. 4 currency peg breaks in 20 years tell the same story. In September 1992, the United Kingdom was forced out of the European exchange rate mechanism. The Bank of England could not defend the pound against speculative pressure. Soros, the same Soros, earned a reported $1 billion in a day on that trade. Black Wednesday. In December 1994, Mexico devalued the peso, then let it float 2 days later. The peso went from 3.4 to 7.2 per dollar by early 1995, 53%. A $50 billion US-led rescue package followed. The tequila effect spread the contagion to Argentina. In January 2002, Argentina's currency board convertibility regime ended. The peso went from 1 per dollar to roughly 3.5 by mid-year. Argentina defaulted on $132 billion of sovereign debt, the largest sovereign default in history at the time. The structural pattern is identical. A peg holds for years. Capital flows in and accumulates, as short-term foreign currency debt. An external shock, a Fed tightening, a regional weakening, a sovereign deterioration, a speculative attack as reserves deplete, the peg breaks, the currency loses 30 to 70%. Local borrowers with dollar liabilities go under. The IMF arrives. The 1997 Asian crisis was the most geographically broad of the four. 6 currencies, 3 continents of capital exposure, $80 billion in net outflows, a global rate-cutting response from the Federal Reserve in fall 1998. July 2, 1997, the Bank of Thailand let go of the baht. September 23, 1998, the New York Federal Reserve convened 14 banks to keep a hedge fund from forcing a fire sale into already turbulent markets. 14 months, 5 currencies, 1 sovereign default. Roughly $1 trillion in outflows, reserve burns, and balance sheet repair. The data is public. Almost nobody graphs it side by side. Every market crash has a pattern. Here it is.